Welcome, welcome, welcome to the deep dive. I'm really glad you're with us today. We're tackling a bit of a financial puzzle that's been making waves. You've probably seen the headlines, right? The euro seems to be, well, soaring against the US dollar. It's sparked a lot of talk, a lot of debate about the dollar maybe dying off. Captures the attention, doesn't it?
It really does. And that narrative that the euro's strength means some big fundamental shift, it's almost universally accepted right now, which is exactly why it's so interesting and honestly why it might be, well, deeply misleading.
Absolutely. So that's our mission for this deep dive. We're going to unravel this whole currency conundrum. We've gone through stacks of sources, articles, research, our own notes, and what they're suggesting is this isn't just a simple story. Euro up, dollar down. Actually, some findings hint this whole euro move might be setting us up for something pretty surprising down the line. So our goal, cut through the noise, separate the facts from, the popular story, help you really get what's actually driving these global currency values, especially the dollar and the euro.
Exactly. And by doing that, we're hoping to give you some insights that, frankly, a lot of traditional financial models are struggling with right now.
Yeah.
You'll start to see why maybe their usual tried and true currency strategies just aren't working like they used to. Get ready for hopefully a few aha moments, ones that might just reframe how you think about currency markets and global finance, too.
Okay, let's unpack this then. First off, we have to acknowledge it, right? The euro has been strong against the dollar recently, undeniably. It's been all over the financial news. But the really interesting part, and maybe a bit concerning based on our sources, is why. It seems the surge is happening for, as one source put it really well, all the wrong reasons.
That's the critical point. That's where we start peeling back the layers. Our sources use this really vivid phrase for the euro right now. They say its exchange value has gone over its skis.
Over its skis, like a skier leaning too far forward.
Exactly like that. Imagine a downhill skier, right? They're flying down, maybe hit a bump, and they just lean way too far forward. They're completely off balance. Pushed beyond their natural support, defying gravity for just a second. That's the euro. It's pushed way beyond what its underlying economic fundamentals seem to justify, which makes it really, really vulnerable. Vulnerable to a sudden, maybe even violent reversal. It's not really a sign that the Eurozone economy is suddenly booming. It reflects something else entirely.
So it's not about genuine economic strength in Europe then. Something else is pushing it up.
Precisely. And this is where it gets interesting. Now look, both the euro and the dollar, they're obviously key parts of the wider euro-dollar system, the basic plumbing of global finance. We can get into that more later. But this specific movement we're seeing, it isn't really about that whole complex system itself. It's about the exchange values between these two specific currencies. And the key point, the one our sources keep stressing, is that this recent euro strength, it looks almost entirely speculative.
Speculative, meaning it's traders betting on a trend continuing rather than, say, solid economic data coming out of Europe.
Exactly that. What we seem to be seeing is a classic case where a whole bunch of speculative traders have gotten kind of, well, trapped on the same side of the trade. And that trade, according to our sources, is this idea of the sell America trade. It's this collective bet that the U.S. dollar is just going to keep falling, and by extension, the U.S. economy must be in, terrible shape.
Sell America, that sounds intense. Is that based on, like, an actual fundamental economic shift, or is it more just a story people are telling?
It's absolutely not a real fundamental economic shift.
Right.
And this is so crucial to get. The sell America idea, it's a narrative. A powerful one, yes. But it's one that lots of institutional investors, lots of traders are acting on. They're basically getting way ahead of themselves. They seem to be misreading the signals that came out of the market after April. And the gap between this narrative and the actual economic reality, it's huge. So much so that even mainstream outlets like Bloomberg, they're running articles asking why their usual currency strategies aren't working, admitting it's baffling even the most seasoned traders.
Wow.
That just highlights this massive disconnect between the old models and what's happening now. It's like driving with an outdated map and wondering why you're hitting dead ends.
That's a huge red flag, isn't it? When the pros admit their models are broken, it tells you something else is going on. And that story often starts with how we measure the dollar, right? Most people probably look at the DXY, the dollar index. But you're saying that index can be, well, pretty misleading.
It can be, yeah. Inherently misleading in this specific context. The DXY, or Dixie as people call it, it's the quick go-to gauge for the dollar's global strength for many. It's basically a weighted average against 6 currencies.
Yeah.
Euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. But the big flaw, the reason it's misleading here, is its makeup. More than half of it, over 50%, is just the euro.
Over half, just the euro.
Yeah. So if the euro does something weird, whether it's fundamentally justified or totally speculative, the DXY is going to reflect that heavily. Even if the dollar is holding up fine against, everyone else, it's like judging a whole orchestra just by listening to the first violin, especially if that violinist is doing some crazy solo that has nothing to do with the rest of the music.
So euro goes up, DXY automatically goes down, even if the dollar's stable against the yen or the pound.
That's the mechanism. Just to give you some numbers, DXY was recently around 97.33. That was up a bit from a low on July 1st, around 96.82, which itself was the lowest it had been since March 2022. Now, for a lot of people seeing that multi-year low, it just feeds right into the narrative. See, the dollar must be dying. But the moment you look beyond the euro or you look at indexes that aren't so dominated by it, you start seeing a very, very different story about the dollar's actual broad strength.
Okay, so how do we get that clearer picture then? If DXY is too Eurocentric, what else should we be looking at?
Right, we need to shift to broader measures. Specifically, the trade-weighted indexes. The Federal Reserve compiles these. These look at the dollar against a much wider basket of currencies, weighted by how much we actually trade with those countries. They give you a very different picture once you look beyond the euro. Let's take the broadest one first. It still includes the euro, naturally, but its influence isn't nearly as huge as in the DXY. This index, it dropped from a peak around 130 back in mid-January. That was roughly the top for the cycle. It came down to about 121 recently, based on the Fed's last calculation. Now, that's not a collapse. It's a retracement, a pullback from a pretty extreme high. And, importantly, it shows you just how detached that whole Sell America story is from the dollar's broader performance. The dollar pulled back, sure, but it's not in free fall.
Okay, a retracement, not a collapse. That's a really key difference. What about indexes focusing maybe on emerging markets? They're usually more sensitive to global risk, right?
That's a great place to look next. The index, focusing specifically on emerging market economy currencies. This tells an even more revealing story. This index actually hit a record high, almost 140, back on April 9th.
A record high this past April.
Yeah, and that was driven by a mix of things. You had these deep deflationary conditions globally, meaning worries about falling prices, economic contraction, and you had extreme risk aversion. Investors were just fleeing anything perceived as risky and piling into the dollar for safety. That period, early April, that was like the final, most intense spike for the dollar in this recent period of global stress. But since that peak in April, things have changed a bit. We've had talk of tariff delays and trade deals, or at least the hope of them. So this emerging market index, it's come down to around 133. And here's the crucial context. That level, 133, is basically back to where it had been last summer and fall, before that whole currency crisis spike really took off late last year. So we're seeing a return to the pre-spike levels for a whole range of currencies. It strongly suggests the dollar's recent weakness isn't some unique new trend. It's more of a normalization.
Can you expand a bit on that dollar shortage spike you mentioned? That sounds like a really important piece, and it's maybe not something everyone understands.
Absolutely. It's key. That spike happened because the providers in the Eurodollar system really tightened the screws on lending and liquidity. Now, just to be clear, Eurodollars aren't euros or physical dollars in Europe. It's this huge, largely unregulated market for U.S. dollar deposits held outside the U.S., mostly by banks. It's the fundamental plumbing for global finance, handling trillions in trade and finance daily. When the banks in this system, these crucial money providers, suddenly get nervous, maybe about their own balance sheets or global risks, and they pull back on lending or demand more collateral, that creates a dollar shortage overseas. It's not a lack of physical cash, but a real scarcity of the dollar credit needed to keep global trade and finance flowing smoothly.
Ah, okay, so it's about credit availability.
Exactly. And that tightening, combined with a shaky global economy and the trade war fallout back then, it just unleashed this huge wave of global risk aversion, pushed everything to extremes by January, led to massive liquidations, forced selling of assets to get dollars, and clear signs of deflationary pressure by late March, early April. Since then, though, especially after April, the Eurodollar world seems to have gradually unwound those extreme defensive positions. And that unwinding has brought the dollar's value against most of the world, outside Europe, remember, back to where it all started last year. Hey, so this is hardly some unique proposition where the dollar is collapsing. It's certainly hardly reflective of the entire world selling against America. The dollar hasn't really fallen like the headlines suggest. It's mainly just retraced the worst part of its last spike up. And that retracement is mostly based on hopes these trade deals happen, which would take the worst possible cases off the table, those scenarios that drove risk aversion and the dollar sky high earlier. It's basically a mini cycle.
And just to put it in perspective, historically, where does that emerging market index sit now, even after pulling back? Is this really some unprecedented dollar weakness?
Great question. Even after this pullback, that emerging market index, it's still just below its highs from 2022.
Yeah.
And you remember 2022, right? That was when everyone was asking if the dollar bull run would ever stop.
Right, yeah, I remember that distinctly.
So perspective and context matters hugely. The dollar's value is coming down, yes, but from an exceptionally high level. And crucially, it's only retracing the worst possible cases. It hasn't undone all the bad cases, just the absolute extremes, which doesn't mean all the negative scenarios are gone. And that brings us right back to the euro and why its situation looks so unique and maybe so precarious.
That makes so much more sense when you put it that way. A correction from an extreme, not some kind of collapse. And what's really striking is how this pattern isn't just in the broad indexes. You see it in individual currencies, too. It's like the same story playing out everywhere.
Yeah.
Except the euro.
It absolutely is. That pattern, the pullback rather than free fall, you see it clearly when you look at individual currencies, even developed ones, not just emerging markets. Take the New Zealand dollar, the Kiwi.
Yeah.
Last year, it was around 60 US cents, already pretty weak. Recession concerns there, global growth slowing, their central bank cutting rates. Then, late 2024, it plunged even further, down near 55 cents. But just like that emerging market index, since early April, it's climbed back up, back to around 60 cents, which is basically where it had been at the start of this mini cycle. No soaring, just back to baseline.
What about the Canadian dollar? Not emerging market, obviously, but
Yeah.
closely tied to the U.S. Did it follow a similar path?
It did, yeah. The loonie was pretty steady, like 1.35, 1.36 against the U.S. dollar for most of last year until around October. Then it started weakening, fell to maybe 1.44 by January and stayed weak until April. But then, same story. Tariff delays, hopes for trade deals, the idea that maybe the worst economic outcomes could be avoided. And it started retracing. Right now, it's back around 1.37, 1.38. So again, this idea of a plunging U.S. dollar and a soaring Canadian dollar, it just doesn't fit the facts. It simply unwound that last most fearful move down.
Okay, one more example, just to really hammer home this consistent pattern across different currencies.
Sure, let's look at Korea's won, often seen as a bellwether for Asian trade, right?
Yeah.
The won was down at 1380 to the dollar mid last year. It actually rallied briefly back towards 1300 in August, September. That was mostly due to a temporary reversal in the yen-carry trade complex thing, but basically shifted flows for a bit. But then, bam, global anxieties hit again. The won crashed hard, all the way to 1478 by January. And it stayed low, just like a Canadian and New Zealand dollars, until April. But then, sensing a theme, it unwound along with everyone else as trade deal hopes surfaced, got back to around 1370 over the last month or so, and stayed there. So, a soaring one. Not even close. Like the others, it's just retracing fears over the worst of the worst cases.
Okay, this pattern is incredibly clear now. Across emerging markets, developed markets like Canada, Asia. So if we pull all these individual movements together, what's the big takeaway, the overarching theme?
The theme across all of them, won, loonie, Kiwi. The broader EM index, it's crystal clear. None of these currencies are soaring against some kind of plunging U.S. dollar. What they're doing is retracing their worst last step. That step was driven purely by extreme fear about worst-case scenarios, mostly trade and liquidity related. These currencies, even after bouncing back a bit, they remain relatively weak in the bigger historical picture. Nothing fundamental has really changed globally, except that last, most extreme leg up for the dollar that ended in April. So the dollar just came back down from that peak, and it hasn't even come down that much. We're basically back to the beginning for this overall mini-cycle of dollar strength. This is not a widespread rejection of America by any stretch. It's just a slight recalibration in risk perceptions, a temporary easing of extreme fear. And that recalibration is exactly why the euro sticks out so much, because it isn't part of this rational pullback. It's doing something else.
So this Sell America idea, it wasn't really based on fundamentals, but it kind of took on a life of its own. Almost became a self-fulfilling prophecy as the dollar naturally came off those April highs. Sounds less like markets driven by analysis and more by, I don't know, emotion. Or just a really catchy story.
That's exactly what seems to have happened. The Sell America idea, it started as a narrative, gained momentum, and then, it became somewhat self-fulfilling in certain circles. And let's be honest, our sources point out this idea got a lot of traction partly for partisan purposes. It's incredibly unhelpful for actually understanding what's going on, but you see it from both sides of the political aisle every single time.
Oh, you mean like one party blaming the current administration for whatever the dollar's doing?
Exactly. For instance, throughout the Biden administration, you had many Republicans claiming the dollar was being weaponized, that its demise was imminent. Now, with the dollar easing off those crazy highs, the narrative flips for some. You hear Democrats, or those aligned, saying trade wars are forcing the world to sell the dollar, sell America, like it's this big coordinated backlash against U.S. policy. And honestly, a surprising amount of institutional Wall Street and the financial media kind of fall into this trap too. They contribute to what our sources call the Sell America FOMO, this fear of missing out on what seems like an inevitable trend. It becomes an emotional wave, not really a reasoned investment thesis.
So it's less about hard analysis and more about jumping on a story that fits a certain political view?
That seems to be the core issue here. The rush to sell the dollar by the euro. It looks like it was based on emotion, not analysis, not rational sense, not fundamentals. It became this momentum trade that just kind of completely obliterated any sense of these fundamental relationships. Remember that Bloomberg article we mentioned? It captures this perfectly. You have traders at big places like UBS Group and Mizuho openly admitting that the models that they use to count on getting it right are instead getting it wrong.
So even the pros are scratching their heads because their usual playbooks aren't working. Why? Why are their sophisticated models failing them now?
Well, our sources suggest it's because these new forces driving currency markets. Things like subtle shifts in global money flows or the complex ways foreign investors hedge their dollar exposure, maybe using derivatives instead of buying bonds directly. These things are just hard to track. The data isn't always clear or timely, it's sparse. That makes it really hard for professionals to tweak their traditional models, which need consistent, clear inputs. And when the data is sparse, what do people do? They tend to fill it in with whatever it is you believe to begin with.
Confirmation bias, basically.
Pretty much. The Bloomberg piece concludes saying experts have been blindsided by the dollar sell-off. They're wondering if it's just chaotic but short-lived adjustment or maybe the start of a harder-to-navigate era. But as our sources suggest, there's another possibility, maybe the more likely one, that the entire premise is wrong, that this whole sell America idea isn't actually what's happening. The economic fundamentals are what they are, and the euro is just acting completely contrary to them.
And if the fundamentals haven't really changed that much, how does that make the euro's recent strength look?
It makes it look, well, completely contrary to everything except for that bias towards believing the dollar's weak.
Yeah.
What's really striking is how the euro versus the U.S. dollar has completely flipped on rate differentials.
Rate differentials, the difference in interest rates between the U.S. and Europe.
Exactly. Normally, that's a huge driver of currency values. Higher interest rates tend to attract capital, right? Investors want better returns, so they buy the currency, offering higher rates, strengthening it. But right now, the U.S. has significantly higher benchmark rates than the Eurozone. Yet the euro is strengthening against the dollar. That strongly suggests money isn't flowing based on interest rate expectations. It's flowing based on something else likely, that speculative sell America narrative. The euro's current strength that's just not showing up in any other market to corroborate strength. You're not seeing it reflected in Eurozone bond yields going way up, or corporate earnings booming, or other economic signs. And that's precisely why the trader models are breaking down, because it's not a real sell America thing. It's something else entirely, something driven by story, not substance.
Okay, so if the euro is basically floating on this narrative, kind of untethered from its own economic reality, what happens when reality decides to, bite back? What could trigger that?
This is where it gets potentially messy. What happens if, say, those trade deals start to fall through? We're already seeing hints, right? President Trump sending letters about potentially going ahead with tariffs on Japan because talks are stalled. Things like that could very quickly bring some of those bad cases, the ones that pushed the dollar up last year, back into the marketplace. Or what if the global economy just starts showing clearer signs of worsening again? That would naturally ramp up risk aversion, increase demand for safe havens, like the dollar.
So if the dollar starts going back up for actual fundamental reasons, more risk aversion, like last year, and the euro is way up here, way out of whack with everything else, completely unsupported by its own economy, what happens to the euro then?
Right. This brings us to what our sources brilliantly call a Y Coyote moment for the euro.
Wile E. Coyote from the cartoons.
Exactly. Think about it.
Yeah.
Well, E. Coyote runs off a cliff, right? And he keeps running for a second, suspended in midair. He's defying gravity. purely on momentum and belief. But then he looks down, he realizes there's nothing underneath him, and gravity takes over. Plummeting ensues. That's the euro right now, according to this view. It's run way ahead of its fundamentals, held up only by this sell American narrative, this momentum. When gravity kicks back in, maybe through a dollar rise driven by fundamentals, the market that was just supported for the narrative gets thoroughly kneecapped.
So the sell America story gets blown up by reality, and the euro suddenly finds itself with no support, nowhere to go but down.
Pretty much. The sell America idea gets thrown right out the window as the market reassesses. And that means the euro will have to itself retrace all the way back to where everyone else is already today, back to where the other currencies already normalized against the dollar. And maybe not just there, but then however farther on the weaker side it needs to go to compensate for any further dollar strength that happens during that correction. Because look, convergence is really tough when you stick out this far. The euro's current position just isn't sustainable without real fundamental backing. Its fall could be fast and sharp as the market scrambles to correct that mispricing.
And this really gets to the heart of the problem, doesn't it? All these misinterpretations, all the speculation. It stems from a basic misunderstanding of what a reserve currency even is and how the whole system actually works.
You've absolutely nailed it. That's the biggest blind spot here. A huge part of why these narratives and biases take hold is that hardly anyone knows what a reserve currency even is, let alone what it's supposed to do.
Right.
Fundamentally, it's the backbone of global finance, right? It's the main currency for settling international deals, pricing commodities, denominating debt, holding central bank reserves. It's the global unit of account, medium of exchange, store of value for most international stuff. And the Eurodollar system, for all its flaws and issues, is currently the only way presently to get any of it done. It's really the only workable framework for a reserve currency that exists today, for better or worse.
So it's not about cheering for the dollar or dollar chauvinism, as you called it, but just acknowledging how the global financial machine actually runs.
Exactly. It's not about saying the system is perfect. It's far from it. But it is the current reality, the infrastructure we have. And to really grasp why the dollar has these wild swings that confuse so many people, maybe an analogy helps. Imagine the whole global financial system is like a massive ocean. The dollar, as the main reserve currency, it's like the primary deep ocean current, the one that shapes everything else, all the shipping routes, all the maritime activity.
Okay, a deep ocean current.
Right. And just like those deep currents are driven by huge unseen forces, temperature, salinity, the Earth's rotation, the reserve currency system has its own powerful underlying monetary mechanics. These mechanics, they operate largely independently of the surface winds. That's the political talk, the rhetoric. And they operate independently of the visible waves. Those are the daily headlines that grab all the attention. Governments might try to steer the ship, influence things.
Yeah.
But the really big, massive movements, they're dictated by these fundamental, often invisible currents of the reserve currency system itself.
So the dollar's big moves, its volatility, it isn't primarily about political choices, who's in the White House or what Congress does.
No. And this is probably the biggest myth in all of this. This deep-seated belief that there is any role for politics in monetary mechanics. The Eurodollar system really doesn't care if Biden or Trump is president. Remember, President Trump famously wanted a weaker dollar back in 2019. Said so publicly, criticized the Fed, but that never happened because of everything I just told you. The underlying mechanics, the market forces, they were just too powerful. Governments don't control money in this global sense, even though they make for a great media story, right? It's easy to blame politicians for market moves. But the narrative that the dollar does this because government did that, it's just not accurate in this context. The reserve currency system has its own way of acting, its own way of behaving. And once you get outside of that mindset, outside of those political biases, you can actually start to see the real, unbiased information that currency movements are giving you. And adding to the complexity, this Eurodollar system, while it's essential, it's also malfunctioning. It's not working as well as it needs to.
It lacks elasticity. It can't easily expand or contract to meet the world's demand for dollar liquidity. It tends to be procyclical, making booms bigger and busts worse. It fuels volatility. Central banks often struggle to influence these huge offshore dollar flows effectively.
So if the experts, let alone the public, don't really grasp these deep mechanics, what fills that understanding gap?
Well, since no one really knows why this volatility happens, because they're focused on the surface noise, not the deep currents, they're going to supply their own narratives. You know the saying, nature abhors a vacuum. This is a perfect example. And this is where political hay is to be made. It becomes really easy to spin a fairy tale that connects complex financial moves to simple political causes people understand or want to believe. And the fact that so many people literally bought it with this recent euro surge, it just goes to show how widespread these biases really are.
Mhm.
The euro, because of this bias, because of the Sell America story, it just sticks out like a sore thumb compared to all the other currencies that are just normalizing. And we all know what happens in markets when something sticks out that much and everyone is trapped on one side of that trade. It puts the euro at risk of a potentially violent reversal. All it might take is just a little bit of a flip in the script, maybe some bad news on trade deals, or a little bit something to trigger another dollar move. Doesn't even have to be a huge dollar surge. And suddenly, the euro finds itself looking down from that cliff edge. It's why coyote moment.
Wow. So thinking about this, what does it truly mean to have a reserve currency? And how do its inherent sort of independent mechanics shape our whole global financial reality, often completely separate from or even despite political aims? This whole understanding, it really forces you to look way beyond the headlines, doesn't it? Beyond the partisan shouting matches.
It absolutely does.
Not
It's about
so-
recognizing these powerful fundamental forces are at play. They operate pretty much regardless of political wishes or what the media is saying day to day, and understanding that what you see right there on the surface, it's often not the whole story, not even close.
Well, if you enjoyed this deep dive into the often confusing world of currencies and reserve systems, be sure to follow, like, and share the deep dive. And hey, for more insights like this, you can follow What Bitcoin Taught Me on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn, all the places. Until next time, keep digging for truth.